What you're looking at right now is not just another geopolitical crisis. It's a chain reaction, a global domino effect where military escalation, energy markets, inflation, and financial systems all collide at the same time. When wars start, markets don't react to headlines. They react to consequences, energy supply disruptions, shipping routes shutting down, insurance costs exploding, and investors suddenly realizing that what looked like a regional conflict might actually trigger a global economic shock. Right now, we are entering what analysts call the financial fog of war, a moment when information is incomplete, risks are asymmetric, and markets start repricing the world faster than policymakers can react, and the first domino has already started to move. We are now several days into a rapidly escalating conflict, and what's emerging is something analysts are calling a strategy of chaos. Instead of one single battlefield, attacks are spreading across multiple targets, military bases, energy infrastructure, shipping routes, and critical logistics hubs. At the same time, drone warfare is playing an enormous role in the conflict. Estimates suggest production capacity could reach 10,000 drones per month. That changes the economics of warfare dramatically because drones are cheap, scalable, and extremely difficult to intercept at large scale. The result is a battlefield environment that is much harder to predict, and when the battlefield becomes unpredictable, markets immediately price in one thing: duration risk. Not just how bad the conflict is, but how long it could last. Everything now revolves around one narrow corridor, the Strait of Hormuz, just 31 kilometers wide at its narrowest point, but one of the most important economic arteries on the planet. If this corridor stops functioning, the impact is immediate. Reports suggest that over 1,000 ships are currently blocked, representing roughly $25 billion in cargo. And according to some estimates, thousands of naval mines may already be deployed in the surrounding waters, which means this is not just a political issue, it's a logistical shutdown, and when global logistics stop moving, markets don't wait. They reprice risk instantly, because supply chains are not designed for sudden disruptions at this scale. Energy markets are the first place where the shock becomes visible, because oil is not just another commodity, oil is trust. Trust that energy will keep flowing, trust that supply chains will keep operating, trust that ships will keep moving. When that trust cracks, prices react immediately. WTI crude has already surged dramatically, marking one of the strongest weekly moves since 2022. But oil is only part of the story. Jet fuel, diesel, shipping fuel, all of them move together. And once fuel prices spike, the shock moves through the entire economic system. Transportation costs rise, logistics costs explode, and global supply chains begin to feel the pressure. In moments like this, investors don't wait for clarity. They move capital, and historically, one asset benefits more than any other during periods of global uncertainty. The US dollar. While many investors expected gold or the Swiss franc to dominate safe haven flows, the dollar has quietly outperformed most major currencies. The dollar index recently pushed toward 99, marking one of its strongest weeks in months. Why? Because when global risk rises, liquidity becomes king. And nothing is more liquid than the US dollar. Capital flows toward the deepest financial system on the planet. This is where geopolitics collides directly with monetary policy. Just weeks ago, markets were pricing multiple Federal Reserve rate cuts. Now that narrative is changing quickly. Treasury yields have been rising again, with the 10-year approaching 4.1%. Why? Because energy shocks are inflationary. Higher oil prices push up transportation costs. Higher transportation costs push up consumer prices. And when inflation expectations rise, central banks lose flexibility. What looked like an easy path to lower rates suddenly becomes much more complicated. That's why some analysts are now warning about a scenario markets fear the most: stagflation, slow growth combined with persistent inflation. In markets, crises don't create uniform losses. They create rotations. Capital leaves some sectors and rushes into others. Right now, the divergence is striking. Airlines are being hit hard. Thousands of flights have been canceled. Airline stocks across Europe have dropped sharply. Fuel costs are rising. Routes are being suspended. But at the same time, certain technology and software companies continue to rise. Companies like Broadcom and Salesforce have posted strong gains, which shows that investors are not exiting markets entirely. They are repositioning. While energy dominates headlines, another strategic shift is quietly unfolding. Technology, specifically semiconductors. The U.S. government is evaluating stricter controls over global semiconductor sales. That could mean tighter export restrictions for companies like NVIDIA and AMD. Why does that matter? Because semiconductors are the backbone of artificial intelligence and modern computing. Who controls the chips controls the future technological balance of power, and governments are increasingly aware of that. Another emerging theme is the militarization of digital infrastructure. Modern warfare no longer happens only on land, sea, or air. It also happens in the cloud. Military operations increasingly rely on cloud computing, artificial intelligence, and large-scale data processing. And when technology companies become part of the defense ecosystem, new risks emerge. Supply chain risks, security risks, and political pressure on tech companies operating globally. One of the most interesting market signals right now is the divergence between software and semiconductor stocks. Software companies are rising, semiconductor stocks are falling. The gap between the two sectors has reached one of the largest levels in recent market history. Why? Because semiconductors sit directly at the intersection of geopolitics and supply chains. While software remains relatively insulated, investors are already repositioning portfolios around that risk. Europe is particularly vulnerable to disruptions in global energy flows. The Dutch TTF gas benchmark recently surged toward $51 per megawatt hour. At the same time, Qatar has declared force majeure on several LNG shipments, which means deliveries could be delayed or canceled. For Europe, which relies heavily on imported energy, even small disruptions can have outsized effects. Energy security is once again becoming a central economic issue. Infrastructure companies are now moving into defense mode. Energy operators are investing heavily to strengthen resilience. One example is a major investment program exceeding $13 billion aimed at reinforcing energy infrastructure and improving system flexibility. Technology investments are also increasing, because in the new energy landscape, resilience is as important as capacity. There's also a growing shift in how policymakers think about energy strategy. The old narrative was energy transition, moving from fossil fuels to renewables. The new narrative is becoming energy integration, different energy sources working together to stabilize the system. Gas, in particular, is increasingly viewed as a stabilizer. Storage levels are relatively strong. Infrastructure is expanding. But the key challenge remains diversification. More supply routes, more flexibility, more resilience. And this brings us to the bigger picture. The world may be entering a new phase where two powerful forces collide: technological acceleration and geopolitical fragmentation. Artificial intelligence is reshaping industries at incredible speed, but geopolitical tensions are simultaneously fragmenting global trade and supply chains. Those two forces cannot remain separate forever. Eventually, they intersect, and when they do, the economic consequences can be profound. Markets can absorb bad news. They can even absorb crises. What they struggle with most is uncertainty combined with duration. And right now, the world is entering exactly that kind of moment: the financial fog of war.